Alright, let's jump right into it. So these are my favorite patterns: ascending triangle and symmetric triangles. Now they can form in many different ways, and as you get experience, you'll get a feel for how these different things form, the different scales they can form on. It's like an endless view, like based on which scale something is flowing on. They can form on multi-week scales, they can form on just an intraday chart. Like these things are always going to be a little different from one another, but over time you'll get a much better feel of how they set up and the way they look. So they can dip in the morning, form a symmetric, get a nice entry. They can be hot in the morning, hold their gains. Nice re-entry can occur for the continuation of that move. And then different ascending triangle pattern. Can buy it as it breaks out. And on all of these patterns and setups, the one thing they have in common is that they all have really precise entry zones and a really precise risk. And so what you want to do is try to let these things develop and fully set up their structure so that you're buying right in that sweet spot where that new trend has just started. And that allows you to risk directly beneath you, because if you're buying a brand new trend, it should go up right away, essentially. And so what that lets you do, it lets you buy in, get an instant price movement up away from your entry zone. That makes the play safer. It makes it so you're automatically in the green, which emotionally that's going to feel better, and it's going to allow you to follow your trading plan more often than not. It's just a much easier and less stressful way to trade. So I'm going to jump into the examples. You got Pixie. I'm going to be going over this day right here. And now you want to always look at the long-term chart of whatever stock you're playing. It's extremely important to do that. You want to just take a look. So is this a former runner? Yes. It is capable of having moves. However, it basically never has day twos. Okay, it always kind of loses its gains back and then just finds new lows, essentially. So really bad company for a long-term hold, but occasionally it'll get a PR, it'll get some news, and it'll have a really nice green day pump that you can take advantage of and make some money on. So let's see. So this was August 21st. This was on everybody's scans, in the morning, percent gain scanner. Everybody was watching this, and it had a really nice move in pre-market. Now in the morning, I did not touch this. High volatility is kind of something I try to stay away from because it's kind of more random. And it's harder to get precise executions. That doesn't mean you can't do it. And in fact, I kind of feel like I should have played this because the structures of this TA was quite good. So the ones that I do see, sometimes you'll get this type of pattern where hot play will dip in the morning. It'll hold gains for a few minutes, and then it'll kind of just start pushing and shifting out of this trend. So this is an entry zone. Now, whenever you make an entry, you should know exactly what you're risking, and kind of my idea of what to risk. Whatever structure that you watched develop, whatever structure that is, it's going to have a precise kind of horizontal support zone. And whatever that support zone is, you have to risk that. So when it pushes, maybe you get in at 447, you're going to just know, okay, I'm going to have to risk this key, this key 435 level. So whatever kind of that range is, so this is like a 10-cent range that you're going to have to risk. You're going to want to just have a rough idea of what you feel you're going to have to risk, and then buy your shares according to that range. Okay, so if you're a newer trader, you might only want to risk $50 per trade. So in this exact spot, you would only take 500 shares. because you have to risk 10 cents. So I wouldn't think of it like a percentage of your account or anything like that. Just think of it like, what's the dollar risk here? And try to get precise dollar risk, the same risk per trade. That's going to make you much more consistent and keep your losses much more controlled. I see this setup. This is pretty good. Again, it's just like not something I was too comfortable with, but you can clearly see it's a nice triangle formation. It's a really nice double bottom, and I really like double bottoms. I think they're extremely helpful for timing an entry. Okay, so you could enter this zone, risking kind of that key support. Now I don't love it because it's so volatile. There is a pretty high chance you're going to get stopped out if a candle slams back down here. That's why I didn't touch this zone. I thought it was just too wild, pretty much. But this one right here is actually probably the one I like the most from the morning, because it gives like a nice bottom, and then you get a bottom here. Now you can see this volume washing. That's really good. It's a nice indicator to use when the volume is kind of washing out like this. It's not perfect, but you get kind of a rough idea, and you get this, one bottom comes back up, double bottom. Now once you get the double bottom, you can start to watch it more closely. And as that bottom holds and it begins to curl, and you can feel that momentum shifting and pushing into the ask after the bid side has held, okay, that's when you can jump in. Something like 517, risking pretty much you can just risk 510, because after that double bottom comes in and the structure is fully developed, it needs to push out of that structure to make that new trend. And if it doesn't push, that's very concerning. Now you can see it does work right away. It just starts to uptrend right away after your entry. It doesn't test. It doesn't even test your entry. And that's really what you want. You don't want it to test your entry zone. And if you're buying really good stuff, it won't. It'll just find the fresh uptrend. So these entries are very precise. You wait for this full development, this full structure, and then you jump in after the support has held. You have to wait for the support to hold before you enter. It's extremely important. And this is something that's going to have, you're going to have to put in the screen time. You'll get some experience with this. You will feel when the momentum is pushing into the bids and testing the downside. You can feel when it holds, you can see it holds for 3 full minutes, and then you could definitely feel when that starts to, the momentum starts to shift and push into the ask, which is when you want to take that entry. And once it breaks out of your entry zone and starts to push for you, well, this is when you just kind of got to follow your plan and then just lock in profits when you feel it's appropriate. Alright, so that's how I would kind of approach the morning on this. Now, again, I didn't even touch it. I just wanted to explain, like, you can battle the morning volatility if you feel like you're ready for that. Even to this day, I'm hesitant battling the morning because, especially in volatility like this, because it can get really tricky and easy to lose a lot of money. So I just was hanging out, on my second monitor, a hot stock like Pixie. This is going to be up on my second monitor all day long. And what I noticed, I saw it bounced from 420 and it was in the 460s. And that got my attention. It's like, wow, that's a really bullish move. It's up 40 cents a share. Let me take a closer look at this. And in this area, it's like, I can't chase this. My interest is not to jump in right away. It's more just, okay, let me just start watching it closely. Let me see if it can form any developments and structures that I can play and take advantage of. So what ends up happening forms this really just great structure. And this is what I'm talking about when I say descending volume. The descending volume patterns are such a strong indicator of when it's completely washed out and the structure is completely developed and completed. And you see, I'm not using this volume surge, I'm not using this as my confirmation. I'm using the descending volume as my confirmation to anticipate that a volume surge may be coming. So it's an anticipation strategy. I'm getting in before the push of volume. Okay, now what you have to do, again, it's just you really want to let it fully wash out. And you can feel as it's kind of forming, so you get this bottom area, and then it kind of has this bottom area, and it's never going to be perfect, you know. It's like you get a candle like this, it's like, okay, you're not going to want to think of this as a double bottom, okay, because this is just like a quick straight down wick, and it's like this needs more time to develop. And if you look at the descending volume, it's like you would force it, you know what I mean? It's like if you draw it, you can clearly see, like, even if you try to slant it down, like, it's just clear it's not a completed volume wash. The average is not good enough, it's not clean enough. And so that's what it really comes down to, having the patience, just having the patience, you know, to really wait for full structure and full development. So in this area, you're going to be able to feel when the prints are going into the bid side. It's testing the support. This is when you don't want to get involved, but you want to watch it very closely. As it holds for a full 1, 2, 3, 4, 5 minutes, it just holds that support like a champ. You can see, because the volume is completely washed out, and in this area I can begin to feel those prints are beginning to shift and be more, you know, weighted towards pushing into the ask. And not just that, you get the bids replacing the ask, and this starts to move up. And this is when you have to take action, because it looks fully developed to me. It's a very tight structured symmetric triangle that has completed its volume wash. It has just held the support. It's going to test the upside, the upper range. It's going to test it. And because it's so developed, the likelihood that this is going to push out of it and go the way I want it to go, extremely high. So now is the time to take action on this. So I bought 5,000 shares. Now for my entries, about 95% of my entries are market orders. That's because I do play low volatility entry zones, and I am very confident in my reaction times and my decision making. Like, I'm just very confident, and I basically don't get slippage because I'm fast and I'm precise. Now, if you're a newer trader, you want to use limit orders, use whatever you're comfortable with, but I would say using limit orders isn't very optimal, because you see, we're not playing exact prices here, we're playing the flow. So as this is flowing, no matter where it's flowing and setting up, the price is irrelevant. What we're jumping in the flow. So we need to get those shares immediately. There's no time to think to plug in an order. You just have to buy it at market. You know, that's like the most efficient way to do it. And I mean, let's just keep it real. There's 380,000 shares. There's so much liquidity. I mean, newer traders might buy 500 shares to 1,000 shares. I mean, you're going to get filled, okay? You're not going to get much slippage. You'll be fine using a market order. Just make sure, obviously, that the bid and the ask is liquid. You'll be good. So yeah, I bought 5,000 shares. I got filled at 470. Now with this, again, just look at the horizontal. Where's that key support that just formed right beneath me, I'm seeing 465, okay? So, so on this play, I wanted to surge and just go up immediately, which it does, okay? And this allows me to risk that 465, because with these plays, you gotta understand, they just spent this much time developing the structure. When it confirms the way you want it to confirm, it's never going to retest, ever. If it does retest, that's a red flag, that's an issue. It shouldn't happen. If it's fully developed and actually a great play, it should never retest. Telling you, it's really bad when they retest, and sometimes it's a trap and they'll dump on you. So this is exactly what you want to see from your plays. Instant uptrend, okay? Now, however you want to play it is up to you. I decided, because of this morning, here are the things that were going through my head. It just ran 60 cents per share. I'm buying the continuation of this bounce. Okay, so based on the scale, it could definitely run another 60 cents. However, this is the second kind of entry, and there's a lot of morning resistance. Okay, a lot of morning resistance, and I didn't know if it would continue and be strong, or if it would kind of just like pop and drop back down. So I decided I would take a scalp approach. So I went ahead and I put a sitting limit order at 489, and I got filled basically right away. Okay, I had no idea where it would surge to. I just knew I could lock up a very quick $1,000, essentially risk-free, and I went ahead and did that. Now, this next part is a little more technical. I wouldn't really expect a newer trader to nail this. The mindset was just, look, if it sets up, because I'm up $1,000 on my first play, I'm going to go ahead and take the re-entries on plays that I feel are appropriate. So, look, you got to analyze in real time the information that is being provided to you. So test 5, it comes down. Now look at the volume again. This is extremely important. You're going to need to learn how to read volume. It's so important if you want to be a day trader. You just have to learn how to read volume. So this, for 2 minutes, it's washing out, so that sell pressure is decreasing as it's holding the range. So that's really bullish. And then, in this minute, I can feel it hold the bottom again, and it starts to push. And I'm anticipating it's going to break out of the micro triangle and test the $5 breakout. So I jump in again after the support holds. And this is something you feel. You can feel where the momentum is based on the prints. You're going to have to also get experience with reading the tape, which is level 2, which is the bid and the ask, and feeling it. You will be able to feel it. It takes a lot of screen time. You can feel where that momentum is weighted and where it's pushing to. So I felt it push to the downside. It held up. I felt the lull, okay? When I said the lull, the period of no prints, where it was pushing down, and then you get the lull. No prints, just sitting there. And then you feel the shift back up. And then this is where you take that entry, anticipating it's going to test 5. I went ahead, took 5,000 shares at 497, risking, basically, on this pattern, if it doesn't push and test 5 and break out of 5 right away, I can actually do 2 different things. If it doesn't push within that minute, I can cut on a time-based approach, which means no matter what the price is, I'm cutting it for a small win just based on the fact that it's not moving instantly for me. Or I can just risk the 491 level. I do a little bit of both, okay? If it was taking too long, I would have cut. Luckily, it did push right away. Gave me that $5 breakout. I made a mistake here. I sold it at 502. I made $250, but obviously something went wrong. I was meant to sell it into the 520 push as an additional $1,100 scalp. I'm not sure what happened. I point this out though because after I messed that up, I did not chase this uptrend. It's very important. You get extremely precise, good entries. This was extremely precise, just extremely good setup. After the entry occurs, you have one shot. You have one shot at a good entry, and then your fate is in your hands as far as where you sell it. But after you sell it, my kind of preference is you're done. Once you sell it, you're done. And when I say, and I mean specifically for that trend, because this trend, okay, this trend right here, this entire trend, it has one very precise entry, which is literally this entry right here that I did. I nailed the entry. That was great. It's a bad sell. So look, wherever you end up selling it, this is the uptrend that began right here, okay? I can't stress it enough. You have to understand what trend you're playing. Like, it's hard to explain, but you don't want to chase a singular trend that had already occurred somewhere far below. Whereas this, I nailed it for a scalp. I let the micro kind of redevelop. It's not overextended though. It's like a continuation of something that is, I'm getting a little too deep now perhaps, but look, the point I want to make is understand where the optimal entry for the trend was, and if it's, if it's too far gone, you have to leave it. You don't want to start overthinking like, oh, this is a micro wedge that he was talking about. I can get in here. No, please don't do that, okay? Because on this trend, if you buy in at 524, you're chasing it because, the optimal entry was 20 cents below you. There's no telling what type of random variance can occur in this zone. You want to be as precise as possible, is what I mean. So don't overthink micro patterns, okay? Don't overthink them. If they are actually very good structure, then you can go ahead and take them, but it has to have proper structure. And if you're a newer trader, okay, use the volume trick that I was talking about with that descending volume. Use that as your guide. If it doesn't have clean descending volume, or at least some type of, if it doesn't have some type of descending volume, please stay away from it, because it's not developed. It's not consistent. It's not going to give you consistent results. Now look at this one, okay? Now take a look at this double bottom. Take a look at how the average volume is descending. Okay, so this has been washing out for a while. I'm going to take this is how you begin to see patterns. The pattern recognition in real time. You'll just understand the stuff after a certain amount of time of what is forming. So after this double bottom comes in, and then this candle pushes right back into the range. It holds the support and then instantly recovers the range. At that point, it clicked immediately. This just had a double bottom. This might be getting ready for the re-entry very soon. Let me zone in, let me focus. Okay, so now this is what I like to do a lot. I like to use micro patterns within the bigger picture to time an entry. So what is this pattern? It's called the 3-minute flag setup. It's a very popular TA pattern for day traders. So you get this first minute, it's a surge back into the range. What happens on minute 2? Lower volume, which isn't like super important, but the most important thing is that it just holds that price. It holds it horizontally for a full minute. Now on this minute, I could feel that support had held, and then it started to push up. I jumped in anticipating that I was going to get a 3-minute flag and it was going to push over this high. And while doing so, break out of the big picture. So you see how a micro pattern really set up nicely with this bigger picture, and it has some really nice descending volume? These are all factors that go into my decision making. So I got in 3,000 shares. I took smaller share size because we're working with a higher, a TA pattern that is now much higher up, and the volatility of this range, you can clearly see the volatility is much higher than these lower prices. Okay, so it's riskier. I got in 3,000 shares at 525. Now here's the cool thing about a 3-minute flag pattern. You can use a time frame approach for your risk. Now, obviously, like when I jump in at 525, I'm risking 520. It's like if it reverses and starts at 520 again, or 519, look, that should never happen. You got to think of the logic behind this stuff, and it's very simple logic. It's a 3-minute flag pattern. Within the minute, it has to surge over this high and flag. Like, that's what the pattern is. If the pattern does anything other than what that pattern is, you cut it. You have to cut it. Okay? Now, so within this minute, if it does not succeed in pushing over 525, I'm cutting it. I don't care if it's holding the price for me. There is some sort of time frame approach that you should mix into your overall strategy, where you're literally just cutting things if they don't do something in a certain amount of time, rather than risking an absolute price point. Okay, there's definitely an advantage in doing things like that, and I highly recommend it. So look, after you get into 525 and it pushes, this is your confirmation that the play is working and going the way that you want it to go, which means you have to then get patient and have to risk risk the important support, which is that 520 level. Now, again, like, because it pushes like this is it's telling you it's okay. It's okay to hold through the pullback. Okay, so you are going to have to hold through this pullback and respect your plan. So it goes from 539 to 523, and that's scary. It's scary for a newer trader to hold through something like that, but you have to trust your plan. You have to trust the logic. The logic is the information that has been presented to you. That information is that it succeeded in pushing over the trend. It's confirmed that it has worked. And you have to trust that. You have to give that some credit. So then it recovers very fast and then does make that bigger push that I was looking for. And you have to think about your plays, kind of like, what's the scale of the play? So I ended up selling it at 558, made, I think, around $700 on this play. Okay, so what do I mean by scale? Look at what happened when it worked this time. It went from 470 to 540. So that's 70 cents of upside. So if it develops again and then pushes out of this trend, best case scenario, it could have another 70 cents of upside. So it could theoretically push to 595. Look, I wasn't trying to push my luck though. You see, like, you could have gone for that. There would have been nothing wrong with it, perhaps. But I choose to lock up the singles. That's $700. I'm very happy with that. And you are looking at a stock that is now really overextended. If you look at really where this is coming from, it's 420. And now it's up at the 560s. And it's pixie. It doesn't like to have day twos. So this is most likely, you're pushing your luck if you're just going to sit here in this range, when the reality is this is just a bounce that had really nice structure, like a bounce and a squeeze. You can make a lot of money on it. It's great, but don't overstay your welcome. Don't overstay your welcome. It's just a scalp ticker. It's not something you're going to want to stay in for a long period of time at all. Okay, so really what this what this pixie example shows is how to take advantage of one-day moves. This doesn't have a multi-day setup, okay? It's just something that had news in the morning, a ton of volume, a ton of momentum, and in the afternoon, some very clean developments that had amazing risk-reward ratio that I could take advantage of, make some good money. Now a little tip, okay? If a stock is very hot in the morning, you want to always watch it, obviously, into the afternoon. And if you see the stock, if you see it has a very clean volume washout, okay, you see how clean this descending volume gets? It's basically completely washed out. Now look, there's a huge difference between guessing the bottom and actually waiting for the bottom to come in, okay? When this is stuck in this nasty descending channel, you don't want to touch it guessing. Like this price action in here, okay? As a newer trader, it's easy to look at this and be like, oh, it's double double bottom, higher low. I'm gonna take this entry right here. Look, like the idea behind that is decent. It's a decent idea, and I can't really hate too much. I can't hate too much for that idea. But I'm never taking it, and the reason why I'm not taking this entry is because there's no consistency here. Sometimes it perks and gives you a nice scalp like it did. Other time it slams back down as a trap, and there is no consistency there. Like, you have to wait for the volume to wash out. That is what gives you consistency. Okay, that's like I'm telling you, the descending volume is probably the most important thing I ever taught myself. It's very, very important, and I highly, highly recommend you respect it and wait for it, because it'll make your trading much, much more consistent. So what I was going to say is that after you see a clean volume wash, you want to ask yourself, does the TA on the chart, can I make any lines, can I make any TA that makes sense and correlates with this descending volume? Okay, so this is when you want to get creative, you want to brainstorm, okay? This is when the time is right to take a shot if it looks good to you. Okay, so what do we have? It holds the support for about 5 times, okay? Get this really nice microstructure where it kind of forms like a double bottom in the short term. And you could definitely anticipate, because these are the factors here. It was $6.20 in the morning. Look at, it's $4.20 now. That's $2 a share discount. It's a really nice discount. It's held the support 5 times now. It went from being in a descending channel to being in a horizontal hold. Okay, it's extremely important to understand the difference. This is a horizontal hold. That is an indicator that this has found the bottom. But even though something has found the bottom more times than not, you will see it will still have to consolidate there for a good amount of time, and you'll get plenty of time to plan this stuff out and get in. Like, have patience. A lot of the best entries take a lot of time to develop. So when you see this double bottom come in and it starts to reverse, you could anticipate that it would break out of this diagonal and you could time the entry. Now look, I did not see this in real time, so I cannot speak to how easy or not it was to time. I suspect this would be kind of hard to catch because it does look like just a strong surge that kind of just went straight up. It would have been difficult, impossible for me to say if it was reasonable or not to catch that. Now, wherever you get filled on this though, you're gonna have to risk the key support, okay? So no matter where you get filled, whether you absolutely nail it at 421 or whether you get kind of a late slippage fill at 427, no matter what entry, you have to risk the key support of 417. That's just that's the logic behind that key support. And no matter where you get filled on that, it's amazing risk-reward ratio. I mean, 60 cents of upside on just this uptrend alone on something that had between, 4 to 10 cents of risk depending on where you got filled on that surge. But I mean, just look at that. Just take a look at the descending volume. I can't stress it enough. This is the one thing that I don't really talk about too much. I don't, when I draw TA and post charts, I don't bring it up. I don't show it. Because it's the one thing that I'm just not willing to tell people. But if you pay for it, if you pay for the information, here I am. I'm willing to do it. So that's the one thing that helps me. And I want to tell you the reason why it's most beneficial, not just for nailing trades, but for avoiding. You will now be able to see and look and be like, you know what? I don't think this is developed enough because the descending volume doesn't look washed out enough. So I'm actually going to give this a bit more time to develop proper structure. And the cool thing with trading, look, there's so many setups each day. Who cares if you miss some? Sometimes I'm sure things will work without the volume trend or whatever. But look, if you wait for these volume setups, you'll get so consistent. It's just a great way to grow a small account when you're a newer trader. That's all I'm getting at. Like when you get more experience and get a bigger account, look, I don't always stick to like these picture perfect descending volume patterns. Obviously, it's just one factor in many factors, but it is a tool, just like VWAP, just like the news criteria, just like the multi-day charts. It's just a piece of information that can help you immensely. And that's why I spend so much time talking about it. Okay, let's move on to IBIO. Now for this example here, I'm going to be going over this day. It was a pre-market gapper. It did not have news, but that's the point. I don't need news in order to play something, but it does have to make sense. So it has to make sense from a technical perspective. So if you look back, you can see, okay, it just held a multi-month support zone. And if you zoom in a bit here, it's like, you know what? That's a really clean downtrend. And if it breaks out of it, it makes a lot of sense because it's so oversold from the 750s all the way down to the 2s. It could have a really big pump and try to kind of correct, a price correction because it's so oversold. So I liked it a lot. And if you think something, from a logical perspective makes a lot of sense, hey, you can watch it even if it doesn't have news, so don't ever feel like you can't watch something because it doesn't have news. News is not nearly as important. The most important thing is actually the technical analysis. So again, a hot stock pre-market, you don't have to be in a rush to play this stuff. Just relax, relax after the morning open and really wait for some good structure. I just want to show this because this is actually the same TA pattern as Pixie, except Pixie formed, and what I mean by that specifically is this. Okay, this is the same TA. Now, Pixie was on a 5-minute scale. Okay, so you're looking at a 5-minute scale, and then on IBIO, this is a 15-minute scale. But it's the same TA. Okay, so understand that everything forms on a different scale. So you'll get better at recognizing it, but definitely, begin to see what scale something is flowing on. Feel it out that way. Get some pretty good descending volume, pretty good. Get this bottom, you get a double bottom, so that's pretty strong. So look, this is a descending wedge pattern, okay? And the idea is you let this form, and you're going to play the reversal of the wedge to get an entry that is for the brand new uptrend that you can hold for a long time, really let it work for you. The idea is the risk reward is amazing. So look, there's some different options here. If you're comfortable, if you see this hold for 3 full minutes and you're like watching it like a hawk, and then you maybe you see a big bid come down at 185, and maybe you're just so confident that you want to just take this push at 186. You're like, whatever, I'm gonna take 186 and I'm gonna risk this 185. 1 cent of risk, and I'm not kidding you. That's how precise it can get. I'm gonna go through a trade in a bit and show you what 28 to 1 risk reward ratio looks like. It's pretty cool. Now look, if you're not comfortable with that, okay, maybe buy this just because it's kind of holding an uptrend. You're like, you know what, it's breaking out of this trend. I'm gonna take an entry here at 188. If you take this entry, okay, risk 186. That's 2 cents of risk. Still extremely good. If you miss those entries, there's one last entry that I think is appropriate. It's this. It's kind of like a 3-minute flag setup. So you can see it curls. It's like, okay, it's out of that downtrend now. Holds for a full minute. What happens on the 3rd minute? It holds the support. Pushes up. So you would anticipate the 3-minute flag. You would take the 190. Maybe you get in at 191 if you get some slippage. And the idea here is you would just risk the 189 directly underneath you. So 1 to 2 cents of risk. So do you see a pattern? Tight risk, very tight risk on this strategy. And that's the last, that was like the last entry you could have taken. And after that, it's like, okay, you missed the optimal entry zone, you're done. You cannot take the entry. If this is uptrending and running, you can't take the entry. You just can't. There's no consistency there. You have no risk management. You just can't take it. So if it explodes and runs without you, oh well, so be it. You know, we're not in this game to chase. We're in the game for consistency. Now, if it does form proper development after that, you go ahead and take it. Okay, so take a look at the development. It tests 2. And then you get some really healthy consolidation with descending volume. It's just another really great setup. If you're an experienced trader, you'll be able to feel this bottom area, and then you'll be able to feel, you know, it comes up a bit, right? It comes back down. This is your double bottom, okay? So after that double bottom comes in and that support holds for 2 full minutes, it's like, it's game time. It's time to go. This is fully structured and fully developed, and it just held support like a champ. It's time to jump in and anticipate the push over 2. So, you know, this setup is all about anticipation, but it has to be responsible anticipation. It has to be anticipation after confirmation that the support has held. I'm going to repeat it a ton, because you need to get it drilled in everybody's head, okay? Wait for the support to hold before you anticipate the shift of momentum. It's very important so you don't get dumped on. Alright, so it breaks out right away. I took 5,000 at 199, risking 197. Now, for me, I like to, you know, I'm a scalper. I take really quick profits. I had a sitting limit at 209 because I was just thinking I'd be really happy with that. I locked up $500 here. Now look, it could have kept pushing into the teens. I got lucky and found the top. You know, sometimes it's going to keep pushing into the teens and you'll get the same structure that forms maybe up here. But if it forms this structure, I'm definitely going to take the re-entry. Doesn't really matter to me what price it is. What matters is the, you know, the structure. Again, you get some nice wash volume. You get just, you know, it's, again, like this is a scenario where this isn't really a perfect double bottom or anything like that, but again, it's more like a feel. Like the overall factors, it feels really good to me. It feels like it is holding the support nicely. Get that good descending volume, holding the range. I'm taking this curl, okay? I'm taking the curl at 208, and I'm risking something like, for this, something like 205, okay? So now you're risking like 3 cents. Maybe you would size down a bit. and I scalped this for an additional 700. So, yeah, I mean, after that, it's just like, okay, you see how it kept going all the way up to 233? So this is my example of when you nail the entry and nail an exit, you don't get back involved in this trend. You don't chase a re-entry in the same trend. You're nailing the fresh entries that you nail and you take. It has to be for a new trend. It should not be to continue playing a trend you've already made money on. Very important, very important. And as you can see, this just never formed a really proper structure again, and it had this dump candle. So once this candle comes in, that's kind of my indicator. Okay, this is going to need like an hour, maybe more, to consolidate and develop again before it even has a shot of me, being willing to take it. So at that point, go ahead and stop watching it, keep it on a second monitor, watch other stocks that have more potential that you can make money off of while this is going to need time to develop. So with things like this, I like to give them a lot of time to really wash out, to really get some good structure, to really get clean again before I'm willing to take a shot at them. I'm not in a rush. Like, after something gives you this, like, you have to understand how amazing these entries were, and just how much money you could have made on this, like, 180s to 230. This is incredible. It's so incredible. When something incredible happens, you need to give it some time. Okay, you don't be in like a rush to force wedge it. Like, forcing this wedge, it's just like, why? I guess you could, but I don't recommend it. If you look at the volume at that point, I guess it's decent. This is kind of hard, because this is honestly, this is the point in trading where it's like, at the end of the day, if you find consistency doing something, keep doing it. So I mean, look, if you can play these kind of wedge setups that are kind of early stages near a dump, go for it. I would not recommend it though. I really wouldn't. It needs more time. Like, it just needs more time to develop and get safer, in my opinion. So I wasn't even watching this in real time. What I waited for this kind of bottom, and I waited for this bottom. I waited for a longer time frame wash that I felt was more proper, like something that was just more properly washed out and developed. You see the difference between like just forcing a wedge, especially when you buy this zone that just had a dump candle near you? That is extremely concerning. Whereas this, it didn't really dump, it kind of crept into that support and then held it. Okay, so you gotta think about these things. Okay, this is definitely more risky to be going for stuff like this that's not developed. Okay, so in this area, there's a couple different options. You could start to play it off this because you're anticipating that this is the last bottom in the play before it starts an uptrend. You could anticipate this. Now, what I ended up doing, I ended up taking this micro ascending triangle pattern and I bought in at 220, risking 218. So the thought process here is, alright, it looks really good, it looks really developed. If it just explodes out of this top and then just consolidates and then tests, and breaks out more, look, I'll miss the whole play if I don't take action right now. I would rather take action and be wrong and cut it than not take action. So I took it. It looked pretty good. Bottom tier, that's no problem. I'm going to hold through this. Makes a lower high, which is concerning, and then when this candle reverses, that's when I'm just like, I'm done. I gave it plenty of time, but at the end of the day, like, this is just, it's not a bullish pattern. It's starting to get sucked into a bearish pattern, and I have to protect myself. So I'm cutting this for a small win, and what I do after that, I reevaluate. So look, sometimes these plays are not going to be straightforward. Sometimes they're going to be extremely frustrating. actually. And you gotta battle them. You really do. You have to battle them and really stick with them and stay logical. Try to stay logical. So you gotta ask yourself, well, how does it react? And so it doesn't fall off the face of the earth, okay? It's able to hold the range. And what do you notice? It recovers that range pretty much instantly and without any issue. Those candles are very bullish. You can see it's kind of making, you could think of this like an ascending triangle. You could think of it like a sloppy symmetric, I suppose. The point is there's a microstructure there and it's pretty proper. So like in this area, once it starts to curl, I'm taking this 226 because it's giving me the okay. It's formed that really proper structure which makes the place safe again. I'm taking it. I'm taking 226, risking something like 223. And so this is what I was talking about. When your play doesn't break out of your entry range, that's extremely concerning. And it can be a big trap and it can get really dicey. So if I'm not cutting it here, okay, I'm cutting it here. I have to cut here to protect myself. So I'm getting out for a small loss. So now I've got a small win and I've got a small loss, and it's like, this is getting kind of annoying. But, again, reevaluate and just take a look. That's a really nice micro pattern. It doesn't dump, it holds the range and starts to curl. Then you'll see it. You'll be like, oh, it's just a triangle. It's nice. It's giving me a re-entry. I'm going to take it. That's what you have to do. And it might feel like overtrading, but it's not. What you're doing is you're hunting for the precise entry that only goes up. That's what you're hunting for. And once you find it, okay, so I buy in at 228, risking something like 225. Holds up for 2 minutes. Then I get the surge out of my entry range. And once that occurs, you can have patience because it's confirming that yes, it's working, and yes, it's going the way you want it to go. Makes the place safe. Everything about it gets better. And so then you can just wait, really let that trend work for you, really try to have patience, and lock in profits, once it's gone up enough. And because the risk reward is so insane on these plays, even if you took a couple paper cuts finding this entry that only goes up, you're going to make all your money back and much, much more once you nail the correct entry. Something to note, like look, if it got sloppy, if it started to get choppy, sloppy, and just not feeling bullish, look, sometimes you're going to have to make the call. Look, I just don't think this is going to do what I want it to do. I'm starting to overtrade it. I'm done. I'm going to stop trading it. And I would say I usually, I'll take 3 attempts at something. And by the 3rd attempt, if I can't find that good entry, usually I'm just like, you know what? I'm going to pick another battle. And I'll just walk away. So, now in this case, yeah, that was a battle. Small win, small loss, finally found it for the nice win. So yeah, and look, this isn't easy. Focusing for a full 20 minutes. I mean, think about that. You're really laser focusing on this. It takes a lot of energy to really just battle with this. But you got to do it. You got to do it if you want the best entries. I'm going to go over one more play on this. Really wraps up IBIO. So if I'm looking at this in the afternoon, I see the volume is pretty much getting washed out completely. I'm like, yeah, that's really nice. This is A quality because it's held its gains all afternoon. And in this area, what I notice is it starts to get less volatile, which I like. Okay, low volatility is good for entry zones. What do you notice about these candles? They're wicky, they're unpredictable, they're choppy, they're big and gross. Okay. Now this one gets like really nice and tight, and it correlates with the overall volume wash, which is on average getting pretty nice. So the reason why I like low volatility zones is because using a level 2, again the bid and the ask, that becomes much more useful during levels of low volatility. because during this test of the downside, right, it's testing that downside. As it holds and you're camping it, maybe you see it, maybe 50,000 shares or 100,000 shares pops up at 249 on the bid. Well, then that's your indicator. Hey, I think this is fully developed. Let me buy into the ask because I think it's going to surge and start rolling. So level 2 becomes much more useful during these low volatility zones on structures that are fully developed and close to forming a new trend. Whereas if you're just buying something, in this choppy, kind of unpredictable zone that's nowhere near the entry zone, well, yeah, level 2 is going to be pretty much useless. So just something to keep in mind. So as the support confirms that it is held and starts to push, I took 252. Again, doesn't break out of the entry zone or the entry range, which is concerning. But look, for 2 minutes, I'm going to hold this. If I buy in and for 2 minutes, yeah, it looks scary, but overall, I'm going to, my finger is on the trigger, ready to market sell if it starts to test 248, because it should never test 248. It just should never do that once it breaks out of this micro wedge and tests the upside. Should never, ever test 248. So that would be an instant cut for me. So for the 2 minute pullback, it holds 250. I like that. That's completely fine. It comes back up, tries to break out of this micro wedge, and it does. But it doesn't flag with strength. It doesn't break out to anything like significant. And this is what I call the last straw. Okay, it's forming a micro pattern. It's basically setting up for a 3 minute flag to push and continue. It's not able to do that within that minute. It starts to come down. This is an instant cut. Okay, I've given it plenty of time. It can't break out of the entry range. We are pretty overextended on the day. If it's squeezed, it could have went a lot higher, but if it doesn't work out, it can crash and burn. Avoid getting stuck in dumps at all costs, okay? Stick to the rules. If it doesn't do what you want in a reasonable time period, and it's failing micro setups, get out of it and reevaluate it. You have to do it. You have to do it. By doing so, I avoid a 20-cent dump. And guess what? When you get emotionally compromised and you get stuck in a dump, you lose logic. And when you lose logic, sometimes you talk yourself into, well, I'm already down this much. Why don't I just wait and hold it for the bounce? And that can lead to disastrous results because then you just hold it longer than you ever thought possible for yourself. And all of a sudden you take a loss that's so much bigger than you ever thought you would ever take. And it's disgusting, and that's why this strategy is designed the way it's designed, to avoid getting emotionally compromised at all cost. Keep the logic simple. It's fully structured, fully developed. Watch level 2, wait for the support to hold. Okay, jump in, go for the surge. If the surge doesn't occur within a reasonable time frame, logically cut. Okay, keep it simple. Either works or you cut. Okay. Now, the reason why that was important to show is because this play right here is the same as this play right here. The risk on this play was the exact same if I did not cut here. It could have done this. That's why I cut here and reevaluated. This obviously formed a re-entry. This one obviously did not. Okay? So that's the explanation for how you battle trends on kind of an all-day scale. But when I say battle, you are still waiting. You're waiting patiently for these things to form proper, responsible structure. Okay? You really want to wait for the volume to wash out. You wait for these big trends to set up. Waiting for them to really set up nicely, especially after such a really bullish morning. Just wait for the proper setups. Wait for the proper candles. Like, do you see how much different these candles are compared to these? I just want to really take a look. It's really important that you understand. Okay, these are low volatility candles. These aren't. These are fatter. These are more unpredictable. Okay, these have more like downside variance. This is more bearish, and these are higher volatility. These are lower volatility. Okay, like I can't stress it enough, and it had higher lows into testing the higher range. So basically, look, it proved itself, okay? It proved itself. And what I mean by that is it play the upside, but then let it prove itself. Don't waste your time playing it when it needs to consolidate, inform structures, and prove itself. Once it's proved itself and then is holding a high range with some low volatility that you can start to make like micro patterns on and get solid entries that aren't just going to like dump on you, that you can have actually a good risk reward ratio and a good plan, that's when you want to take a shot at it, okay? It's extremely hard to explain this stuff into words. I'm trying my best, but the truth is you will have to put in the screen time and get in the experience to understand what I'm talking about. It takes a lot of experience. Alright, let's go over AMD. Now for this play, I'm going to go over something that happened a while ago because I have a live trading example of it. And I'll send that to you in your email. I'll send the live trading video where I show myself talking about the TA in real time, analyzing the tape in real time. So I'll go ahead and do that. Now, the day I want to talk about is the 13th of January. Now, leading up to this day, the reason why I was watching it is because I had noticed, okay, so a lot of times in trading, you'll notice certain days will occur, like this had a lot of volume, and it perked. And it's like, you know what? That's pretty interesting because it basically had bad news and gapped down. But what happened is it formed kind of this micro ascending triangle. It broke out of it and then started to try to fill this gap. And so after that occurred, I was like, oh wow, I'm going to watch this and just see what happens for the next few days. As long as it's holding a bullish trend, I will continue watching it. So then it perks again, forms another wedge. Now really, I just didn't like it for an entry on any of these days. Like it just didn't really feel good enough for me to take an entry. I just didn't like it enough. But on the 13th, it got really bullish and it just felt right. Felt right to play it. So let's go all the way back to January. So this was the day. Now, in the morning, it has this perk. And it's like, okay, you could play something like this. Now, I chose not to play this, but you could absolutely play this, especially because it has a multi-day setup. Decent descending volume, again, it doesn't have to be perfect, and this is certainly not perfect by any means. It's almost a non-factor, actually, on this play. You could just clearly see, though, it has somewhat of an entry zone where you could risk this key support of like 138 area, so maybe a 143 entry. It's just not my favorite. The TA is just not strong enough in my opinion, so I sat that out. Now I saw this. Now I like when plays move. So this moved to 20 cents a share, and then it held those gains all morning, which is really strong. And look at the descending volume pattern. You see how clean and just nice that is? That is what I look for. That's what I really like. And this is an example of actually how you can use a micro pattern within the big picture again to time a more precise entry zone. So essentially the idea is as the support holds, you can take it as it proves that it held the support, and then it starts to curl out of that support zone. So you could take something like 158, risking, something like 154. Or maybe you would have to risk 153. But the point is, this is a more optimal entry as opposed to waiting for it to get into this entry zone where it's a bit more tricky, because like in this exact play, like if you wait until it breaks out of the top when it clearly gave confirmation below it using the micro pattern within the big picture, look, you would have got stopped out here. Like there's no way to get around it. Like sometimes these plays will do weird stuff, and you know, it's like if you, it just happens, guys. I mean, it just happens. I don't know what else to say. Like sometimes the plays screw you over, you know, and that's why if it's clearly giving you a micro setup, I highly recommend taking it. Take the optimal entry as it occurs, and it's a proper one though. You see how it's super precise, it's super low volume, it's very clean. Okay, like it's not forced, it's extremely clean, and that's what I'm trying to get across, is really pay attention to the way these candles form and look. You want things that are fully structured, low volatility, and clean and precise, and that really did provide that, and it led to another really nice 20-cent move. Okay, so the play that I played on tape was actually this ascending triangle pattern right here. I liked how it had descending volume all day. It held that support from the morning and then just made these higher lows all day, just higher lows. Began to chip away at this resistance until finally I felt like it was completely ready. I bought 2,000 shares at 180, literally the second that it went up, and it'll be easier to understand why, especially with that live trading video. It's kind of a boring video, it's 30 minutes long, but that's kind of the point. You know, it's kind of the point to see what it looks like when somebody is really zoned in, really waiting patiently for perfection, analyzing that level 2 to really feel it out, really feel when it's ready to go. And just seeing that, I think it'll be really helpful to kind of understand, you know, the focus required and the patience required to time like just really, really precise entries. And I ended up, you know, it wasn't that strong, you know, like when it broke out, I was very concerned in the video. I was like, oh man, this is having trouble moving 5 cents. Like this is just not strong. So I ended up cutting it at 189. I made $150, you know, pretty much a non-factor here. But I just wanted to show how to really time an entry, and I'm going to talk about the mistake I made on AEMD. So let's just think. Let's think a minute. What mistake did I make on this? And the mistake I made wasn't even on this day. It was not keeping it on watch. I forgot about it. I basically was like, oh, my play didn't work. Forget this stock. Forget this stock. I don't like it. I'm done watching it. Yeah, I don't make that mistake anymore. But back in January, I was making the mistake still. Look, what do you notice? See something? I see a descending volume pattern. I see a micro triangle setup, held the range perfectly for 2 days in a row. That is like super red flag. And by red flag, I mean it in a good way this time. Like, you have to watch it. Have to watch it for the surge day. It's perfect. Look at how the TA, I want to just point this out. Look at this TA real quick. Just take a look at it. Look at the flow. This is a flow you see on an intraday. Now, we're saying this on a multi-week. TA can form on any time frame imaginable. It's so interesting to me how they can form on different time frames, but they do. Look at it. Just look at this. This is something you see on a one-day chart of a hot stock. This is happening on a multi-week chart. Look at this. This is how you read flow. Once you understand how to read flow and you get better at reading flow and just understanding what scale the stock is running on, you will understand how to better time optimal entry zones. Really nice stuff. So let's just take a look at the 16th. Okay, so you gotta understand, on the 16th, okay? Let's just think about this real quick. Lots of thinking. You have to think as a trader, right? You gotta think. Now, coming into this day, I wouldn't jump in here. I wouldn't be too eager to get involved here. It would have happened too fast. I would have been like, I don't really know. Okay, but this is like top watch material because it held the range for 2 days in a row. We're looking for it to surge on this day. Okay, now it perks in the morning. It holds those gains as like a channel. And then you could take this entry here. So it gives like a little micro hold. Holds the range here. Look, this is something that I would say is speculative and a bit creative. Okay. You can take 191 though. You can absolutely take 191 risking something like 188. That's a 3-cent risk. And the reason why you can take this on basically really iffy TA structure, it's because the scale of this ticker is not intraday. It's not intraday scaled, it's multi-day scaled. And because we're aware of the multi-day scale, this is why we can take this speculative entry. But even though it's a speculative entry, it's still extremely precise, and it's a very logical, straightforward plan. It perked in the morning, it held gains for what, 15 minutes now? And now it's curling, and we're taking the anticipation for a new high of day breakout on something that has a perfect multi-day pattern. It's extremely logical. And if it doesn't work, we're only risking 3 cents. What do we have to lose? Okay, so that's what I'm talking about here. Taking logical shots on something that has amazing risk-reward ratio. So once you get this entry, I can't stress it enough. If you take 191 with a 188 risk plan, you have to respect your plan. You have to. You just have to do it. You have to suck it up and you have to respect it. And if you don't respect your plan, at least respect yourself. Okay? At least respect yourself. You owe it to yourself to stick to your plan. You truly do. Again, descending volume, kind of a non-factor on this particular play. Now, VWAP on this day was probably around 191. It was a VWAP hover pattern. It may have even been around 185. I'm not, obviously I don't know for sure. I prefer plays that hover around VWAP or a little above. Those are probably the best factors when it comes to VWAP. But again, VWAP is just another tool just like everything else. So don't take it like the holy grail or anything. None of these factors are necessarily more important than the others, but you want to just feel all the factors and just feel it out. You can feel out how good a play is or not. So anyways, this is a nice ascending triangle pattern. Now here's the thought process with this. Okay, I'm going to give you a quick rundown. If you take this entry, good job, you nailed an amazing entry. If you watch it form a perfect setup, you can add here at 201, risking something like 197. Let's just call it 197. So that's 4 cents of risk you can add. Now look, if you took a nice size in the morning and you're happy with your size and you don't want to put on that additional risk, then don't. Then don't do it. That's fine. Okay, that's fine. Let's say the level 2 was a bit iffy. Maybe the sizing on the bid and the ask was a little bit iffy in this area, and you only felt comfortable taking 1,000 or 2,000 shares. But in this area, because more eyes are on it now, and it's like a nicer pattern, maybe in this area there's some more liquidity, and now suddenly it becomes proper to take 5,000 shares. Okay, now these are things I think about because that's the I'm at that point in my trading career where kind of those liquidity factors are meaningful. And so maybe I can add with a bigger size because it has developed in a way where it's actually safe and appropriate now to take 5,000. Whereas maybe in this area it was only appropriate to take 2,000, right? Just something to think about. Now, just an absolutely beautiful surge here, and I would be locking in profits in the 240s because this is absurd. And what else is there to say? You know, you were risking 4 cents on this entry and you just could lock up 40 cents within 5 minutes. Yes, please. 10 to 1 risk reward ratio. Yes, please. And that's not even talking about this 191. Okay, 3 cents of risk on the 191, locking it up in the 240s. Yes. Yes. These are the types of trades that will make you profitable for a very long time. A long, profitable career. This is the type of entries that you need to know. Okay, so this entry is definitely, it takes a lot of experience to nail something like this, I would say. You get the bottom, you get this double bottom area. Now for this, you're going to want to kind of use this micro wedge and take this, you know, something like 245, risking the 237 support that just held underneath you. So for something like that, that's 8 cents of risk. So you're going to want to take a smaller size in this range because you have to risk more. Now for this, the 245 gets a really nice surge up to 270 too. Look, if you want to lock up a quick 20 cents a share, look, I'm not going to hate on somebody for doing that. Like, that's something I would probably do. You could also just stick to the plan, hold through the pullback, and wait for the bigger trend. Look, the option is all yours. You know, you can really play this stuff however you prefer, you know, so just do whatever feels right for you. Now, oddly enough, I probably wouldn't take this. I don't really like this development. I honestly probably wouldn't take it, but once this pops up like this and it holds for a full minute, look, I would probably take this as a 3-minute flag setup and just literally I would scalp like a quick 20-30 cents within 1 minute. I would be out right away. So I like this play because it really shows, based on where you enter a play, it shows the type of patience you should have. So for some earlier morning entries, these are called trend entries, where you're getting in so early that you're playing it for the overall trend, where you might not want to, you know, your profit target, you might not want to use a price approach, you might want to use a time approach, where you just tell yourself, hey, I'm going to give it 2-3 hours because this is a really beautiful multi-week development, multi-day breakout. I just want to let it roll for a couple hours, and wherever it goes, it goes. If your entry is good enough, you can do that. If you get in at these higher price levels, you have to be more scalpy. You have to lock in profits faster. You get the point. But there's one thing that doesn't change ever. The one thing that never changes is once you enter, the risk is always precise and planned out. That is the one factor that will never change with this strategy. Okay. I do want to point something out real quick. What do you notice? If you see this is very hot, this is a gross channel. Have I said this before? I think so. I think I have. What do you see? Descending volume completely washed out. Okay, what do you notice about this area? It's not descending anymore, it's horizontal. What do we know about horizontal? That means the bottom structure is holding nicely and it could develop into a re-entry for a fresh, so a new afternoon uptrend could occur. Okay, so again, when this volume is totally washed out, you want to ask yourself, well, can I make anything that makes sense? And I kind of see this wedge formation. So you zoom in here. It's a really nice wedge. Okay, you can use this micro bottom. It's kind of like a micro wedge, but look, it's clear. It's like really clear that the entry zone occurs right here. So 244, you would have to risk the key support of 240. That's 4 cents of risk. Look at where it leads to, 30 cents of upside here. Now I would probably hold for a bigger trend, but look, I would use this TA, and then once it breaks down on me, I would get out here. So it wouldn't be like a home run or anything, but you're still looking at 15 cents of upside on basically a play that failed. Look, that's still 3-to-1 risk reward. That's still a really nice play. I'm just trying to point out, like, how when things are developed, you can do anything you want when you're working with developed, structured TA. And what do I mean by structured TA? It's really just things that are washed out, that have held a price zone for a long enough period of time with some higher lows and some nice structure that allows you to time a precise entry with a precise risk that does not get hit very often and has a lot of upside potential, right? That's what I'm talking about with these setups. Now, honestly, I would probably stay away from all of this because these candles aren't really, they're not good enough. Like, it's just not good enough. I would keep an eye on it though, and then like I probably wouldn't play this, but like once the surge happens, then it's like, okay, game on. Like it's bullish again. It could develop again. Look at that development. Look at that descending volume, how clean that is. Take a look at how the liquidity starts to enter in those candles. You know, you can just see the difference between this, which is like, there's just nothing happening. It's too slow. But then it ramps again, gets some proper structure, and you get some really nice development. I mean, look at how nice that descending volume structure is into a nice double bottom. So you get the bottom here, you get this bottom zone here. Once that support holds up, you take this entry anticipating a surge. Get in at 269, risking 266. That's 3 cents of risk. Led to 25 cents just right here. And the total upside, 50 cents on the peak upside. Now obviously you're not gonna find the peak upside. Usually you're not gonna find it. So look, like these, when I'm talking about these secondary entries, by the way, I am gearing this more towards the experienced traders that have a lot of screen time, that have a lot of experience. Okay, but for the plays that new traders want to focus on, these entry zones down here, okay, these multi-day setups that you can actually prepare for and get amazing risk reward on, these plays are going to be harder in the afternoon. They're going to take more experience to really nail and know when the time is right. It takes a lot of practice, you know, I can't stress that enough. Like screen time and practice, it takes a lot of it. There's no shortcut. There's no shortcut to this stuff, you know. But at least by understanding some of these concepts that aren't talked about a lot, like the descending volume pattern, I think understanding that concept alone makes this video call worth it. Just being aware now, oh, descending volume is a thing, it's a pattern that occurs, and it actually means something very important. Oh, okay. That's a takeaway that I don't think anybody talks about. It's something that I taught myself. It's the most important thing I've ever taught myself in trading. It really is. It's so important that you at least keep it in mind. It's so important. Okay, there's one play I want to go over. It's a play from today. Very good play. HAPP, I believe, was the ticker. Yes. Yes, so this play is a 9 mil float. It is biotech. It had some news, some random news. Happy News receives policy granting it 8% tax rebate, which is, that's good. That's good for the company. Which, again, like, do I know for a fact it's good? No, but I perceive, okay, the market might perceive this as good. It is a former runner, okay, so when it dips, it is able to bounce $1 a share occasionally. So I know it's capable. It's also, look at where the stock's coming from. Like, what are the best stocks to long? The ones that are the most sold off, oversold. It's the opposite of what's the best stocks to short. The ones that are stupidly overextended. Well, the ones that are stupidly oversold, turns out they can be some pretty good long opportunities. Not always, obviously, but that's kind of my idea behind playing things that are washed out and curling like this. And then, yeah, you get that PR with the tax news. It's like, you know what? It could break out of this channel. People basically just saw it fail a trend, so maybe they started shorting heavy because it's maybe just an awful company. They're expecting it to continue lower because it's such a bad company. All of a sudden, a bullish PR hits, and a huge correction happens. So that's what I was watching for in the morning. Now, this perk, there wasn't really enough structure here on this for me to feel comfortable. So I did not play this in the morning. But that's okay. Like, you're going to see this happen a lot, where you're going to miss morning perks because they're just too unpredictable. And the risk reward on a morning perk like this, like, you just can't be there for it. And the risk reward isn't even good if you jump in, because who knows what's going to happen with this. So I'll tell you what you want to do. You want to just wait. Just give it some time. So, as you can see, it holds up. Okay, it holds the gains all morning. Holds those gains. That's important information. Right? Like, that's information being presented to you in real time. It's extremely important. Descending volume, look, it's clean. It's sloppy, sure, but it's pretty clean. Now, I'm going to give you the biggest factor on this particular trade, okay? So, in this area, saw 100,000 shares pop up at 185. Or maybe it was this area. But the point is, there's 100,000 bid prop on 185. In this area, a 30,000 bid prop came up on 184. So now I have 30,000 shares at 184 and 100,000 shares at 185 that's been there all morning. Nobody's selling into it. It's not getting tested. Okay? So now you have a very interesting situation on our hands where I have a stock that is perked from 175 to 185, 10 cents in the morning, holding gains all morning. 100,000 shares right underneath the 186 entry. So if I take 186, 100,000 shares is right beneath me at 185. If it doesn't start to curl and doesn't get going, if people start to sell into that 185, guess what? I can dump into that large bid prop and only lose 1 cent a share. If I'm wrong, and maybe it moves a little faster than I thought, which is highly unlikely, by the way. I think 9 out of 10 times I get filled at 185 if I want the fill. Okay? But there is an additional fat support at 184. Okay? And the fact is, those bids held all morning. The longer they hold, the less risky this play gets, the more likely that it's going to go the way you want it to go. So that is why I took 186. I took that right in here. Okay, took 5,000 shares, and then I added 5,000. Okay, 10,000 shares at 186, literally risking 185. Literally 1 cent a share. And I'm not just throwing out the 1 cent a share thing. Okay, you see people throw out these price zones that are like super unrealistic. No, this is literally 1 cent a share. There's a 100,000 share bid prop right beneath me. Okay, that's 1 cent a share risk. Now, what did I say earlier about when you enter something and it starts to work the way you want it to go? Okay, so I get in, it perks. It finds the perk out of my entry range. This means the play is working. The play has confirmed that it's working and that I need to now test my key support no matter what. So, you're going to have to work on this. It's going to take a hell of a lot of discipline. You're going to have to work on this. You have to stick to your plan no matter what. On a play that is at the very bottom, very low volatility, the play hasn't even gotten started yet, okay? You have to stick to the plan. You just have to. There's no option. Either sell it at your risk or give it time. Okay, stick to your plan. Please stick to your plan. So that's exactly what I did. I stuck to my plan. You know, my profit target was like the $2 breakout for the bounce on the long-term chart. Depending on how strong it was, I would gauge it that way. But it was clear. I wanted the $2 breakout, and I was thinking it'd go, 210 to 220. Best case scenario, maybe 240 surge if things got really wild. So look, this is what it looks like when you have a precise plan. When you nail something that is so good, you can become so comfortable in this because your risk is only 1 cent on something that has proved itself all morning and the bid support is proper. So it's a little bit of analyzing level 2. It's a little bit of understanding the long-term chart potential, the PR in the morning, right? The fact that it moved 10 cents in the morning. These are all factors that I'm thinking about, okay? I ended up selling it at 214. And I actually made a huge error. I made a $500 mistake on this, believe it or not. That was painful because I don't know what I was thinking. I used a market sell. I don't know why I did that. I should have just used a limit sell and I would have gotten filled at 220 easy. I got some weird slippage and got filled at 214. That was a mistake. So learn from my mistake. If you're up a ton of money and it's flowing in a range, just put a limit in, get filled with the limit. I would say I use limit orders for my sell probably like 50% of the time compared to, like I said before, my buy 95% of the time I'm using market. Because, for the sell, you want to try to put it in a limit order where you think the surge is going to go. Alright, anyways. Yeah, so just take a look at this curl, take a look at this chart, okay? I wanted to show volume is not as important on the long side as people make it out to be. TA structure and appropriate level 2 analysis in a lot of cases is good enough to justify an entry. 1 cent of risk for 28 cents of upside. That's 28 to 1 risk reward ratio. I only had to be right 3.5% of the time to break even. If I'm right any more percent than 3.5%, I'm printing money on this. I know I rambled a bit about this play, but it's so important to understand. It's just so important to understand that, structures and entries and timing. The scales on each play can be so much different. But overall, the one thing they all have in common, they hold support and prove that they can hold that support level before I take the entry. I make sure I have support underneath me so that I won't get dumped on, and then I stick to my plan. It's so important, guys. Just so important. Alright, so that's pretty much all I got. Let's see, it's been an hour and 34 minutes. I think I'm going to end this video call here. So I hope you enjoyed the call and got something out of it. I went over a variety of different plays, different perspectives, different things to think about. I think that if there's one key takeaway, start looking at how that descending volume correlates with the structure of the TA pattern. And screen time is number one. The importance is screen time number one. Keep practicing. Paper trade the strategy if you want to try it out. Don't be afraid to get creative with your paper trading and really just take some shots when you think things are logically good, and stick to your plans and see how it goes. Alright, cool. And maybe in the future I'll make maybe I'll get some good plays in the future, and I'll be able to make a fresh video with kind of recent hot plays that I've nailed, and just go over the TA and talk about my perspectives on those newer tickers that are in play. I think that would kind of be cool to make this a series. That would be kind of cool. Could do that. Alright, cool. Well, I really appreciate you investing your money into this call. It's thousands and thousands of hours of work has gone into kind of developing and really polishing the strategy, and I would just say don't get discouraged if you don't get it right away. I mean, here's the thing that's trippy about this. I knew what to do for a full year. I knew what I had to do. I knew what the setups look like. I knew the tendencies. I knew what they feel like and look like. It took me a year before I could get the discipline to execute it with perfection. It just, don't get discouraged. It takes a lot of time to learn how to just trade, how to trade price action, how to trade not just patterns but trading flow, and really just knowing what has the proper risk-reward ratios, what has that really nice upside potential, and what's an appropriate attempt. Have patience if you're not comfortable with something. Let it roll without you. Just learn from it. Just observe it. Learn from it. Take a mental picture. Be curious. On your scans, pull up random tickers. Take a look at their long-term charts. Go back as far as you can. Go with anything. Just go back as far as you can. Take a look. What's going on? If something spiked, be like, oh well, why did it spike? Well, this had a downtrend. It kind of perked out of that downtrend, made a 3-minute kind of flag thing, 3-minute setup on the daily chart, and then it broke out of it and surged. It's okay, cool. And you do that. You just do that for as many tickers as you can every day. And it doesn't even need to be something that's super long or complex. You can take 10 minutes a day. Just pull up the tickers off the scans on size trade. Okay, quickly, what do you got? 9 mil flow. Real estate sector. Okay. $6 price zone. Okay, it was at 480. It washed down to 3, and then it surged up to 6 or even more. Surged to 7 after hours. Kind of a new ticker. Okay, that's interesting. On to the next. That's the main factor. Okay. AEMD had a morning move. You might be like, oh, okay, it had a morning move. You know what? That had some decent TA here. Nice kind of morning wash. Nice TA here. And you'll see these patterns all the time. This is the pattern I just talked about for a long time. If you miss this entry, okay, perks holds for a full minute. That's a 3-minute flag setup. It's still appropriate. 219. Risking literally a cent for the 10 cents of upside. This proper risk reward ratio. Lock it up when it gets weak and doesn't do much. Okay, and then you might want to ask yourself, okay, it's 11 mil float. healthcare sector. Let's take a look at the long-term chart. It's not really a big former runner. The spikes it has aren't huge. Usually takes multiple days to run. Not really the best stock to day trade. Once in a while it's pretty good. The main factor here is that it had that news from the day before and then it washed out. Okay, it washed out completely and then formed a little bounce pattern in the morning. So look, I just went on a tangent essentially, but those are the factors. Those are literally the only factors that I think about. Float, sector, long-term chart. The most important above all other factors is intraday TA, which is on the day that you're playing it. Does it have proper structure so that you can time an appropriate entry with defined risk on a ticker that is, maybe former run or something that is able to spike and move, so that you have the proper upside to make that risk reward worth it. Those are the most important factors when you're thinking about going long. Alright. So, yeah, I mean, I really poured myself into this video. I just really hope that you feel it was worth the value. Hope maybe a new perspective on trading. Yeah, thanks again. Just appreciate it.